Hi, this is Wayne Zell, and welcome to Blueprint for Wealth, your video cast that hopefully helps you realize your personal dreams of wealth and freedom. And today we have a special guest, Josh Keene, who is a partner as well as on the executive committee at Johnson Lambert. Welcome, Josh. Welcome to the podcast.
Great. Good to see you, Wayne. Glad to be here.
Good to see you too. A little bit about Josh first. I'll give you a little bit of his background. He is a partner, a CPA, and an auditor and a technical advisor for insurance companies, nonprofits, and employee benefit plans. But he also has another side to him, which, you know, most accountants, they have lots of sides to them, as I can attest. And outside of the office, he likes to play guitar. He stays active by running, and he likes to just make music. But beyond that, he is very involved at Johnson Lambert, both in terms of servicing clients, but also sort of overseeing the financial side of the firm. So we'll talk a little bit about that. Josh, tell me a little bit about you. Where did you grow up? How did you end up getting to Johnson Lambert? What was your path?
Yeah, so I actually I've seen a lot of the world. I had nomadic parents. My parents got married very young, right out of high school, and moved to Denver, Colorado, actually Grand Lake, Colorado, a little mountain town. And that's where I was born, me and my brother there. And then we moved from Grand Lake to Dallas, Texas. Spent a couple years in Dallas, and then about 7 years in Broken Arrow, Oklahoma. And luckily we moved. My dad sold a company in Oklahoma that he had built up, sold that company, and we moved east to the East Coast. So we moved into Richmond, Virginia, and that's where I spent the last half of my high school career, and then went to William & Mary down in Williamsburg as college, and then
great school.
We
can attest to that.
I owe a lot to William & Mary. I've met my wife there, as well as met Johnson Lambert. So
awesome. And did you go straight out of William & Mary into Johnson Lambert?
Yeah. So I watched your podcast a couple weeks ago about Larry Johnson. You had him as one of your guests, and he was one that came down recruited on campus. You know, it was the Big Six were coming down doing their song and dance. And I listened to Larry, said, okay, let's go be the little guy, slay dragons, and have fun doing it. And that really resonated with me as a young student, early professional. And yeah, it's been a one-stop career. I just finished my 24th busy season now with the firm.
Wow. So. Johnson Lambert. So it's Larry Johnson and Debbie Lambert, both visionaries. They split off a while back, but Debbie continued to grow the firm, and it was sort of her vision to continue it. Tell us a little bit about Johnson Lambert. How many folks are there today, and how is the firm focused?
Yeah. So I've been part of the firm, like I said, for about 24 years. When I first joined, we had two offices. We were here in the Northern Virginia area, and then Burlington, Vermont. Since then, we've grown. We added 6 more offices, kind of conquered the East Coast, the I-95 corridor, and now Chicago and Atlanta were our last two. We have about 180 professional employees serving clients in our primary industry niches, which are insurance companies, not-for-profits, and employee benefit plans. And that seems like a very basic business model that Larry and Debbie started when they stepped away from their predecessor firm, saying, let's just go be that alternative to the Big Six and have that small firm feel as far as who we are as individuals, but also that big firm feel when we go to deliver service to our clients, that we can stand toe-to-toe with the big guys.
When you refer to the Big Six, I kind of laugh. When I joined public accounting 42 years ago, it was the Big Eight. And I was with a firm that was once powerful, then became defunct, and is now powerful again, Anderson. I also worked for Price Waterhouse and Coopers, but I understand the strength of these firms. Now it's the Big Four, and there are a lot of firms that are behind it. Where would Johnson Lambert fall in the rankings of accounting firms nationwide? Do you have any idea about that?
Yeah, so we're fairly small as far as a firm goes. Revenue size, we're probably in the top 100 firms in North America. But inside the insurance industry, we are now number 5. So we call them the Final Four. The Big Four is the name that everybody knows when you go through college and get recruited. But little Johnson Lambert now is number 5 in North America of auditors of insurance companies. And so that's really something we take a lot of pride in.
Yeah, I mean, you all are experts in the insurance industry and auditing insurance companies. How did you maintain that focus, and how do you continue to maintain that dominance over all these other firms that are out there?
Yeah, so insurance is a unique industry. It's one of those you don't know your cost of goods sold until many years down the road. So you're pricing these products, and a lot of estimates go into their financial reporting process. So being a deep expert in that field definitely is required. There's a different regulatory environment. There's a whole different basis of accounting for insurance companies, statutory accounting. And so really being able to stay on top of what's new and exciting in the industry. We volunteer and serve in various leadership capacities. So have members on the insurance expert panel for the AICPA, serve on the auditing standards boards and different aspects that we really just, we look a lot bigger than we are as a firm. And that I think our clients really appreciate that we are sitting there around the table as decisions are being made at some of these regulatory environments and can bring that information to them real time and stay in front of the change that's always on the horizon, because that's one thing that the insurance industry is always doing, is evolving and changing, and lots of things going on to keep in touch with.
What types of changes are you seeing now in the insurance industry, particularly with respect to how they're being audited and financial accounting standards board standards and the insurance industry standards that are being imposed on the insurance companies? What changes are coming about?
Yeah, so I think all industries are seeing this. Just the data analytics, the wave of the future is going to be in big data and using that information to identify risk. Be able to do continuous audits to a certain degree, rather than just one time a year coming in, beating up one balance sheet. The insurance industry has done a pretty good job of adapting to change. Obviously, there's peaks and valleys along the way, wildfires, hurricanes, all the things that we all have to deal with as far as what's out there. We've got to insure the risks on, and then responding to the pricing that goes along with it. And then our jobs as the auditors is to make sure, and the regulators as well, is make sure those companies are there to make good on the promises that they've sold. And so that's really the role we play, is making sure that there's assurance over the numbers that they're presenting and the solvency of those organizations.
It's interesting that you touch on big data. How do you all, as an accounting firm, utilize and access data to do the auditing function? I imagine that you're testing some of the assumptions that they're using when they're making predictions about claims and losses going forward.
Yeah, so it's definitely an evolving science, and a lot of investment being made internally on our side of things, but also within the industry. We really focus in on our core industry being the property casualty market. And so we've developed recipes for being able to take a premium register or a loss register and run it through and come out with canned analytics and different data analysis that really is useful for us as the auditors, but then sometimes in a consulting capacity when we're not serving as the auditors, using that to help our consulting clients to glean information that they may not have access to themselves.
Are you having to hire specialists in data analytics and artificial intelligence today?
We are. We've actually got a really great chief innovation officer who really, he's grown up inside the firm and has really kind of been our back office guy, but he's really leading our internal initiatives as far as where to make our investments in the technology, and then using internal resources as much as possible to then, really customize those tools to meet the needs that we're able to then turn around and sell to the marketplace, or again, just keep up with the pace of change around us as the auditing industry, more and more is shifting towards that electronic environment rather than what used to be very much a paper-based process.
Has Johnson Lambert gotten involved in any of the captive insurance companies around the country, micro captives as well as the bigger captives?
Yeah, so we try to stay away from the micro captives to a degree, just so they've got some
bad press,
some IRS scrutiny. Yeah. But yeah, that was the founding change that Larry and Debbie jumped on right away when Vermont passed their legislation to allow captives. They were the first domicile in the United States, and so we were on boots on the ground first off. As that legislation came out, and we now I think audit more captives than any other firms up there, and so. Big names like Coca-Cola and other things, but also, like I said, some smaller, family type risk retention group, or not risk retention groups, but we do audit those retention groups, but smaller captives that are single parents that are just writing one or two policies a year type thing.
How did you all get involved in the nonprofit side of things, and how big of a practice is that as part of Johnson Lambert?
Yeah, so it's been a part of us since '96, so about 2 years before I joined the firm. Uh, Two individuals left away from another firm, joined Johnson Lambert. They knew Larry and Debbie from their prior experiences and said, let's do this together. And so that was here in the Northern Virginia area, which obviously has a lot of concentration of nonprofits given the proximity to DC. And so yeah, that's been a part of our niche focus. In the Virginia office, that's probably 45% of our revenues coming out of the nonprofit space. So a
Wow.
good chunk of our
Do
revenue.
you all get involved on the tax side of things, or is it just purely auditing and assurance?
Yeah, so we do definitely have a tax expertise. Nonprofits, while they're tax exempt, still have compliance requirements, and so we've got a nonprofit tax team. And then the insurance space, there's a lot going on with our tax projects there on the consulting side, as well as those that we're actually serving as the auditors for.
And then there's also a portion of the practice that deals with employee benefits as well. So are you all auditing qualified plans and 401k plans? Is that typically your focus?
Yeah, you're very timely. This is the kickoff of our benefit plan season. Most of those have calendar year ends, but the work usually happens in the summertime.
Keep everybody
And so
busy.
yeah, it's a good mix for us. We have a lot of interns coming through, so it's a great experience for them to actually get real client experience working on an audit. But yeah, that is primarily what we do from June to October 15th deadline is working on those employee benefit plans.
And in terms of the percentage of the practice, if you had to estimate, what percentage is the insurance, what percentage is nonprofit, what percentage is employee benefits?
Yeah, so like I said, about 85% of our revenue firm-wide is on the insurance space.
Wow.
That includes work that we do. Regulators tend to outsource some of their exams. We have actually a regulatory team that serves as the arms and legs for regulators as they do their financial condition exam, auditing the insurance companies themselves, their financial statements, as well as the tax services. So about 85% there. And then probably 10% of our revenue is coming from the nonprofit practice. But here in Virginia, as well as our Chicagoland office, that's the
Pretty
other big
significant.
component of our.
Are the
And
nonprofits
then,
mostly trade associations, or are they also charities, 501c3s, C4s, and that type of entity?
yeah, it's a good mix. A lot of trade associations here in Virginia, again, given the proximity, the lobbying for the
Yes.
trade groups. But yeah, the charitable organizations are fun and exciting. I love working on those as well, out there doing good in the world and have a nice mix of things that, they're actually doing, kind of capital formation to make projects happen around the world that are doing good, either green initiatives or small business, minority owned, women owned activities. So it's a neat mix to work on all three of those industries.
Sure.
But I do really love a nonprofit that's out there just making a change in the world
That's a big
and
part
how
of
we
my
can help them.
practice too. I really enjoy that, and it's something that you're always giving back when you're helping them. Yeah, even if they're paying you.
Yeah.
One last question for you today, and that is really dealing with business succession. I'm writing a book on business succession planning. It should be out this year. I'm interviewing a lot of different people about their business exit plans or business succession plans because it's not always an exit. And the interesting thing about Johnson Lambert is I don't think there's really an exit anticipated. I think it's really continue to grow and thrive and allow partners to retire and bring on new partners. Tell us a little bit about how your business succession plan works without revealing too many confidences, but also the idea of non-exit for a small niche firm.
Yeah, no, I think I said this before. I wouldn't want to play chess against Debbie Lambert because I think she was always 10 moves ahead. But you were instrumental in helping the firm, kind of morph from what it was when Larry and Debbie were the core partners. Our partnership agreement has been written in a way that it's clear up front about how folks will retire. Debbie was our third retired partner now. And we've got a payout plan that works basically, 10 years after retirement, there's a value that's been calculated. It's known up front, and it's really incentivizing folks to grow the firm. That the calculation is based on firm-wide revenue rather than being your book of business. And so that really does, I think, help transition in a safe and healthy way that people aren't hoarding the book of business to maximize their retirement value. They're out there, let's go grow and sell, pass on what you've learned, and pass on those clients to the next generation to keep them in the firm as long as possible. And so, yeah, I think that's really, it seems like a simple strategy when you step back from it, but it is also one where you just don't have to have that argument of, hey, I'm worth this and this is what my value is and you're going to buy me out. It's really been designed in a way that everyone joining the partnership knows upfront what it means and what their expectations can be heading into retirement.
So it's done as a team. It's done as a complete firm. No one individual controls the value or the value of the firm. And that is what is so beautiful about the business succession model that you all have constructed. And it was a pleasure to be a part of that because the creativity that went into that was incredible. And I applaud you all for that too. It's not an easy thing to achieve in professional services, particularly. Everybody says, hey, that's my client, right?
Yeah, no, and I think you were instrumental in helping us navigate through that evolution of the firm. So really appreciate your wisdom and advice along the way.
One last question for you today, and that is, if the economy were to turn down and were to adversely affect property and casualty insurance companies, which is a large part of your business, or if there was a major disaster which affected companies. I remember there was a company back in the late 90s, early 2000s that a friend of mine actually had started. It was a big property casualty insurance company out of New Jersey, did not survive. How will that impact your practice and impact the business succession plan at Johnson Lambert?
So I think that's one thing that I really appreciate the insurance industry. It's very well regulated, and so those insolvencies are few and far between, luckily. But it's also a great hedge against downturns in the economy as being an auditor of insurance companies, because they have to have it by statute every year. They have to have an audit of their financial statements, and so regardless of whether things are going well in the industry or not, they still have to hire auditors to do that work.
Beautiful.
So that's really where we kind of have a hedge against the downturn in the economy.
Do you feel that you have an edge also because of your size? You're able to offer services at a more economical price than what the Big Four would offer?
Yeah, we just don't have the overhead that the Big Four national office brings to the table, and some of it's got an advantage and some of it's a disadvantage, right? There's a lot of investments that are necessary in the technology side of things that are expensive. But yeah, so I think really when we go toe to toe from a service perspective, the value we bring is that expertise at a price that makes sense, that is not the New York City Big Four billing rates. It's the Johnson Lambert billing rates. And it's also done in a way that it's, our biggest clients sometimes are the smaller clients of the Big Four. And so we can really deliver that service proposition and value and the relationship that they're looking for as a business partner in a way that they're near and dear to our hearts as much as we are to them.
Awesome. Thanks, Josh. We've been talking with Josh Keene, a partner at Johnson Lambert. And if you want to know more about them, visit them on the web at johnsonlambert.com, correct?
That's correct.
For all of you that are operating insurance companies or contemplating it, or nonprofits, if you need some help on the audit side, please check them out. I'm Wayne Zell, and you've been listening to Blueprint for Wealth. Thanks for tuning in, and stay tuned for a special topic right after this. If you're an executive and you need help with your executive comp, let me give you some pointers on what to look for when you're structuring your executive comp program. From an overview perspective, we want to know what the company's goals are and what the employees' goals are. And we want to know what tools are available for you to use as an executive or as a company to compensate your executives. What are the key ingredients of an employment agreement that the employee wants and the company wants? And lastly, what are the tax and securities law issues that we have to face? The company's goals, the employer's goals, mainly are to attract and retain the very best talent possible. They want to minimize the risk to the company of not being subject to restrictions, not having the executive subject to restrictions. You want the executive subject to restrictions like non-competes, non-disclosure agreements, and non-interference agreements so that you can protect your core business. And you want to align the incentives for the executive with those that will increase shareholder value. On the executive side, The executive's looking for fair base pay to start. They're looking for strong incentive compensation arrangements such as bonuses and possibly equity in the business to participate in. They want clarity in what their roles and obligations are with respect to the company and the do's and don'ts that could get them into trouble if they don't do it the right way. And finally, they want flexibility so that if they're terminated without any good cause, or if they leave for good reason, they're protected. The compensation tools are myriad, but base pay really is established by looking at surveys that might be available in a variety of settings. I've given you a link to one in particular that might be very helpful. The tools also include benefits, healthcare coverage, other perks such as a company car or vacation that's written out in the employment agreement. What incentive comp can this individual expect to see? Long-term incentive plans, executive bonus plans, simplified executive retirement plans, non-qualified deferred comp, synthetic equity in the form of stock appreciation rights or phantom stock, real equity like stock and stock options, or profits interests in a partnership setting, and a change in control bonus. All of these are tools that help us ingrain the executive into the business and also keep them for a longer period of time. An employment agreement is going to outline a variety of things in detail, and it's going to include the duties and responsibilities for the individual, things that they're not allowed to do in the form of prohibitive activities or prohibited activities. Compensation, what is their comp, what are their benefits, and what are the rewards that they should expect, and how clearly is it spelled out? What's the term of the agreement, and what are the terms of renewing it? Also, what happens if they leave employment? Are they subject to a non-compete agreement versus just a non-interference or non-solicitation? What's the scope of that, and is it enforceable under local law? What's the effect of being terminated without cause, and how do you define cause in the employment agreement? Probably one of the most heavily negotiated provisions relates to these provisions that encompass when an individual is compensated if they leave employment or not. If they leave because they're terminated with cause, they should expect a lot less than if they leave because they're terminated without cause. And what are their severance arrangements? How long will the severance continue, and what are the conditions to getting the severance, such as signing a general release? In the form of equity, there's various forms, but real equity is stock, restricted stock, stock options in the form of incentive stock options or non-qualified stock options, or a profits interest, which really is only available in a partnership tax setting. Synthetic equity includes phantom stock, which is really a non-qualified deferred compensation plan, and stock appreciation rights are closely aligned with phantom stock in the form of significant synthetic equity issues. When you get this equity grant, the question is, what should you do and how is it reported for tax purposes? Well, stock is treated as property. So if you receive stock as an executive, you've got to report on your tax return the fair market value of the stock received. If it's not vested yet, you may be able to make an election to have it taxed now, perhaps at a lower rate, and lock in the holding period for long-term capital gains treatment. If it's deferred comp, you've got to be careful so that you don't run afoul of various rules, including Section 280G, which imposes an excise tax on golden parachute payments, and Section 409A, which also imposes an excise tax if you haven't complied with the really rigorous 409A regulations. The SEC requires disclosure if you're in a public company setting. The CEO, the CFO, and the three other highest compensated executives have a lot of information disclosed about their compensation in proxy statements, Form 10-Ks, and registration statements that are filed with the SEC. The disclosure can be as basic as summary compensation tables, but then there are subtables within the disclosure documents that give significant detail regarding the compensation arrangements. And of course, if you own stock in a publicly traded company, you're obligated to file forms with the SEC if you're one of these 5 individuals every time you acquire the stock or sell it or transfer it. So those are some highlights of executive compensation issues that an executive faces and the entrepreneurial company must face when they're hiring their executive team, which is key to the success of any entrepreneurial company in terms of business exit or mergers and acquisitions. If you've got questions on executive comp, give us a call at 571-203-9355 or visit us on the web at zellaw.com. Have a great week.